Have you ever noticed how when the news starts screaming about a recession, wealthy people get quiet? Not panicked quiet, strategic quiet. Like they know something the rest of us don't. And here's the thing, they do. While everyone else is frantically trying to protect what they have, the wealthy are doing something that seems almost reckless. They're getting ready to buy. Here at Simple Money, we've spent way too much time studying how different groups of people react to economic downturns. And what we've discovered is that the difference between who gets destroyed by recessions and who gets wealthy from them isn't luck. It's not intelligence. It's not even starting capital. It's something much more fundamental, and once you see it, you can't unsee it. Today, I'm going to break down the exact psychology, strategy, and, frankly, the uncomfortable truth about how the wealthy approach economic downturns, and why everything you've been taught about playing it safe during tough times might be doing more harm than good. Here's what's really happening. When you hear recession is coming, your brain immediately goes into threat mode. It's this deep, primal thing. When resources get scarce, you protect what you have. You stop spending, you hoard cash, you avoid any risk whatsoever. This feels responsible. It feels smart. Every financial advisor on TV is telling you to build your emergency fund, cut expenses, hunker down. And look, I'm not saying that's wrong for everyone. But here's what nobody wants to admit. That defensive posture, that fear-based decision-making, that's exactly what keeps most people from ever building real wealth. Because while you're protecting your $3,000 in savings, someone else is using the recession to acquire assets that will be worth 10 times more in 5 years. The fundamental difference comes down to what I call the survival mindset versus the opportunity mindset. And this isn't about being reckless or having a higher risk tolerance. It's about understanding something most people never learn. Recessions don't destroy wealth, they transfer it. Money doesn't vanish during economic downturns. It moves. From the fearful to the prepared, from those who panic sell to those who strategically buy, from people reacting emotionally to people executing a plan they made years ago. So let me walk you through the 5 reasons why the wealthy don't fear recessions, and more importantly, why they position themselves to profit from them. The first reason is what I call the cash position paradox. During good times, when everyone's feeling wealthy because their home value went up or their 401k is climbing, they spend accordingly. New car, bigger house, that vacation they've been putting off. They feel rich because their net worth on paper is increasing. But here's the cruel irony. Most of that wealth is locked up in assets they can't or won't sell. Your house, your retirement account, your stuff. When the recession hits, suddenly everything is worth less. But they still have the same expenses, the same mortgage, the same car payment. They're asset rich and cash poor, which is a fancy way of saying they're broke with nice things. The wealthy do the exact opposite. And it feels counterintuitive. During boom times, when everyone else is spending, they're boring. They're holding higher percentages of cash or liquid assets. They're not maximizing their lifestyle. To an outsider, it might even look like they're not taking advantage of good times. But what they're really doing is staying flexible. They're keeping their powder dry, as the saying goes, because they know something most people don't. The best time to build wealth isn't when the economy is soaring. It's when it's crashing. But you can only take advantage of a crash if you have cash when everything's on sale. Think about it like this. Imagine there's a store where everything you want goes on sale for 50 to 70% off every 7 to 10 years. Houses, stocks, businesses. But there's a catch. The sale only lasts for a limited time. And you can only shop if you have cash in hand. No credit cards accepted during the sale. Most people show up to that sale completely broke, because they spent all their money when things were full price. The wealthy show up with bags of cash they've been setting aside specifically for this moment. It's not about being smarter, it's about being positioned. The second reason is the income diversification shield. When a recession hits, the first thing that happens is job losses. Companies cut costs, layoffs happen, and suddenly your single source of income, your job, is at risk. For most people, their income looks like this: one stream, their paycheck, maybe a little interest from a savings account, that's it. So when recession fears hit, they're terrified. Because if that one stream gets cut off, everything collapses. The mortgage, the car payment, the groceries, all of it depends on that single paycheck continuing. Wealthy people structure their income completely differently, and this is where things get interesting. They typically have multiple streams: rental income from properties, dividend payments from investments, business profits, capital gains, maybe royalties or licensing deals. Some of these streams are actually recession resistant or even recession proof. People still need places to live. Certain businesses do better in downturns. Some stocks pay dividends regardless of the market. So when a recession hits, even if one or two income streams take a hit, the others keep flowing. They're not betting their entire financial life on one employer's decision. But here's what makes this even more powerful. Because they're not terrified of losing everything, they can actually be opportunistic during recessions. They can leave a job that's toxic but pays well because they have other income. They can take a calculated risk on a business opportunity because failure won't mean homelessness. They can hold investments through the downturn instead of panic selling at the bottom because they don't need that money for groceries. Fear makes you reactive. Security makes you strategic. And recession-proof income creates that security. The third reason, and this one's particularly important, is what I call the debt divide. Not all debt is created equal, and wealthy people understand this in their bones. There are two types of debt: debt that makes you money and debt that costs you money. Most people only have the second kind. Credit card debt at 19% interest, car loans on depreciating assets, student loans for degrees that didn't increase their income. When recession hits, this debt becomes a crushing weight. The payments don't stop, but the ability to make them becomes harder. This is when people lose everything, not because they made one bad decision, but because they're drowning in debt that only flows one direction, out of their pocket. Wealthy people use debt differently. They use it as a tool to acquire income-producing assets. A mortgage on a rental property where the rent covers the payment. A business loan that generates returns higher than the interest rate, leveraging low-interest debt to invest in opportunities with higher returns. During recessions, this type of debt actually becomes more valuable. Why? Because they can refinance at lower rates. They can acquire more assets cheaply using that debt, and the income from those assets helps them weather the storm. Their debt is working for them, not against them. And here's the uncomfortable part. When recession hits hard, over-leveraged people are forced to sell their assets at terrible prices just to survive. Who's buying those assets? The wealthy. Using strategic debt at historically low interest rates that always accompany recessions. The system literally transfers assets from the desperate to the prepared. It's not fair, but it's predictable. The fourth reason is the knowledge asymmetry. Most people learn about financial markets from headlines, social media, and panicked news anchors. Market crashes 40%, retirement savings evaporating, economic catastrophe. Their entire understanding of what's happening comes from sources designed to trigger fear, because fear drives clicks and views, so they make emotional decisions based on incomplete, sensationalized information. They sell when they should hold. They pull money out of investments at the bottom. They avoid opportunities because the headlines tell them everything is collapsing. Wealthy people have spent years, often decades, studying market cycles. They understand that markets are cyclical. They've seen this before. They know that every major downturn in history has been followed by a recovery. They know that some of the greatest fortunes were built by buying assets during periods of maximum pessimism. Warren Buffett didn't become a billionaire by following the crowd. He became one by buying when others were fearful and selling when others were greedy. And he could only do that because he understood something most people don't. Short-term market movements are noise, but long-term trajectories are signal. This knowledge allows them to stay calm when everyone else is panicking. They're not smarter, they're just not operating from the same information diet. They read different things, they talk to different people, they have advisors and networks that help them see opportunities instead of just threats. And because they're calm, they make better decisions. They can evaluate an investment opportunity rationally while someone else is just trying to figure out how to not lose their house. But here's where it gets really interesting. This knowledge gap is 100% solvable. You don't need to be wealthy to learn how markets work, to understand economic cycles, to develop a framework for thinking about recessions. The information is out there, but most people never seek it out because during good times, they don't think they need it. And during bad times, they're too stressed to learn. The wealthy make learning about markets and economics a priority before they need it, which is exactly why they're ready when the opportunity comes. The fifth reason is what I call the timeline advantage. Average people live paycheck to paycheck, which means their financial timeline is about 2 weeks to maybe 3 months. They need their money now or very soon. They can't afford to have their savings locked up in an investment that might take 5 years to pay off, even if that investment would make them wealthy. When recession hits and their investments drop in value, they often have to sell at exactly the wrong time because they need that money for immediate expenses. They're forced to realize losses because their timeline is short. Wealthy people are playing a completely different game. They're thinking in 5-year, 10-year, 20-year timelines. They don't need the money they invest for decades. So when a recession hits and the market drops 30, 40, 50%, they don't panic. They know they're not selling for 10 years anyway. In fact, they're excited because everything just went on sale and they have a decade for it to recover and grow. The same market crash that devastates someone on a short timeline is a massive opportunity for someone on a long timeline. This is why wealthy people often get more aggressive during recessions, not more conservative. They're buying stocks at huge discounts knowing they'll hold them for years. They're acquiring real estate that's been foreclosed or panic sold, knowing that property values will recover. They're investing in businesses that are struggling but fundamentally sound, knowing that economic conditions will improve. They can do this because they don't need that money back next month or next year. Time is their secret weapon. Let me tell you about 2 different people to make this concrete. Let's call the first one Marcus. Marcus is 32, makes $70,000 a year at his job, has about $8,000 in savings, and maybe $15,000 in his 401k. When recession warnings start hitting the news in late 2007, Marcus gets worried. He's been thinking about buying a house, but now he decides to wait. Prices might drop, and besides, what if he loses his job? He pulls back on everything. Stops his 401k contributions because he wants more cash on hand, puts off that certification program he was considering because it costs money. When the market crashes in 2008 and his 401k drops by 40%, Marcus panics. He moves everything to bonds to protect what's left. Housing prices in his area drop by 50%, but Marcus is too scared to buy. What if they drop more? What if he can't afford the mortgage if something happens? By 2013, the economy's recovering. Marcus's old 401k investments have bounced back, but he missed the entire run-up because he was in bonds. Housing in his area is back to 2007 prices, and he still hasn't bought because now they seem expensive again. Marcus made every decision based on fear, and while he didn't lose everything, he missed the single biggest wealth-building opportunity of his generation. Now, let's talk about Jennifer. Jennifer is also 32, also makes about $70,000 a year. But in 2006, she started reading about market cycles and real estate patterns. Nothing fancy, just basic financial education. She understood that markets go up and down, that crashes create opportunities, that fear is the enemy of wealth building. When recession warnings hit, she didn't panic. She actually increased her 401k contributions. because she understood that buying stocks cheap is better than buying them expensive. She'd been saving specifically for a house, keeping her lifestyle below her means, and building up her emergency fund to 6 months of expenses. When the crash happened and her 401k dropped, she felt the same fear Marcus did. She's human after all. But her knowledge helped her stay the course. She knew this was temporary. When housing prices in her area dropped by 50%, Jennifer bought a modest house. Not her dream house, something she could easily afford even if she lost her job. She locked in a crazy low interest rate. By 2013, that house had nearly doubled in value. Her 401k had recovered and grown. She refinanced her mortgage at an even lower rate and used her equity to buy a small rental property that was still cheap. Jennifer didn't have more money than Marcus. She didn't have better luck. She had a different framework for understanding what was happening. Here's what most people don't realize. The wealthy aren't lucky. They're not playing a different game. They're just playing the same game with a different strategy that they spent years developing before they needed it. They built their cash reserves during good times. They diversified their income streams years ago. They learned how markets work when the stakes were low. They structured their debt strategically. They extended their timeline. And then, when the recession everyone fears finally arrives, they're not scrambling. They're not panicking. They're shopping. This might blow your mind, but some of the wealthiest people we've studied actually get a little excited when recession warnings start appearing. Not in a cruel way. They're not happy about people losing jobs or struggling, but they know that a recession means opportunity. It means assets are about to go on sale. It means competition for deals is about to decrease. It means interest rates are about to drop. It means they're about to have the chance to deploy capital they've been saving for exactly this moment. And here's the really uncomfortable truth that nobody wants to say out loud. The system is designed this way. Recessions function as a transfer mechanism. They move wealth from people who are overextended, underprepared, and operating from fear to people who are liquid, educated, and strategic. Every major recession in history has minted new millionaires and billionaires, not because they caused the recession, but because they were positioned to take advantage of the opportunities that recessions create. While one person is forced to sell their rental property at a massive loss to avoid foreclosure, another person is buying that property for cash at 60 cents on the dollar. But here's what gives me hope, and why we're talking about this on Simple Money. This isn't some secret society knowledge. You don't need to be born wealthy to adopt these strategies. Every single thing we've talked about is something you can start building right now. The cash position paradox, the income diversification shield, the debt divide, the knowledge asymmetry, the timeline advantage. These are all things you can start working on regardless of your current financial situation. The person who starts thinking this way at 25 with $10,000 will be in a completely different position at 45 than someone who never makes this mental shift. Even if they earn twice as much, the wealthy don't fear recessions because they've prepared for them. They've built the cash position, they've created multiple income streams, they've structured their debt to work for them, they've educated themselves, they've extended their timeline, and most importantly, they've trained themselves to see opportunity where others see only threat. When you understand that recessions are cyclical, predictable, and full of opportunities, they stop being something to fear, and they start being something to prepare for. The question isn't whether another recession is coming, it is, markets are cyclical, and downturns are inevitable. The question is this: when it arrives, which person will you be? The person scrambling to protect what little they have, making emotional decisions based on fear and headlines? Or the person who's been preparing for years, who sees opportunity instead of just threat, who's positioned to acquire assets at massive discounts while everyone else is panicking? That choice isn't about your current bank account. It's about the decisions you make starting today. The wealthy aren't playing a different game. They just learned the rules before they needed them. And now, so have you.